This isn't a yield review. This is a full performance breakdown. What happens if you reinvest? What happens if you take the income? And does DIVO actually hold up against the broader market? Most income strategies sound good on paper. Dividend growth, covered call income layered on top, lower volatility, and steady payouts. Usually when you hear that combination, there's a catch, because income almost always comes at the cost of growth. So the real question isn't whether DIVO pays. It clearly does. The question is, what does it actually do to your long-term wealth? Does the options overlay quietly drag performance? Does the income make up for it? Or does it actually strike a balance most investors overlook? Instead of debating yield or marketing language, I ran a full backtest. Up markets, pullbacks, reinvested income, income taken as cash, total return measured against the broader market. And what the numbers show might surprise some growth investors. Let's open the spreadsheet. Welcome back to Simply Money. So today we're looking at DIVO. This is where we take our portfolio, our income portion of the portfolio, and we invest it hypothetically in one fund. And today we're looking at DIVO. What would have happened if we put all of that into one fund? And what would the performance be if we did a full drip, 50% drip, or no drip at all? So we're going to start here on the spreadsheet. Those that are new, this is a spreadsheet we use on all these scenarios. There's a playlist with all the different funds you can look at on the channel. If you like this spreadsheet, you're always welcome to grab a copy at the Buy Me a Coffee link in the description below. This is the DIVO, D-I-V-O, drip. So what we have here is looking at the spreadsheet. The date that we are starting this is July 20th, 2020. Now, DIVO was around a little bit before this, but we're going to be doing another comparison with DIVO compared to JEPI in another video, which starts on the same date. So I wanted to do the same dates on DIVO so we could do the comparison in another video, and that will be coming out soon. So keep an eye out for that. The yellow markers here are where you can change the information. So you can start it on any date you want. This date we're starting on, the share price was $28.22. This is a monthly paying dividend. It pays out every month. Here's your symbol, DIVO. And with that $525,000 that we're investing, and again, you can change this on the sheet to whatever amount you want. If you start with $1,000, you can put that in and see what happens. With our portfolio, we were able to get 18,604 shares. We're going to look down here. Column A is the dates each month, and column B is the share price. And then column C will be how much the distribution was on that date. And we'll look at the different scenarios. So let's start with the share price. That's always something people want to see. Is there NAV erosion? How's the share price? Is there any growth and upside with this fund? Well, look at DIVO here from July 1st, 2020 at $28.22. You can see coming down here to the end of March 1st, 2026, $46.72. So over this time frame, it's had a 65% growth in its share value, which is great for something you're looking at for getting some income. Always obviously having growth is a benefit that comes with that. I want to look through this real quick at a couple dates. This starts after the recovery of COVID, so we don't have that drawdown. But if we come to 2022, which was a pretty bad year for the market, I want you to notice this. I think this is important to see. Starting in the end of December 2021, it was at 36.15, and it really didn't come down that bad during 2022. The lowest it got here was 32.80, which is obviously down, but it's not like a drastic drawdown. So it had a nice protection during this time frame, and I think that's important to remember. And then it recovered after that, which is also important because if something can protect you on the way down, that's great, but is it going to rebound and come back up when the markets are good? And during 2023, 2024, and now even 2025, it continued to show upside. So those are important things, I think, to note in evaluating these funds. Now, that's not everything, and we'll look at more information that's vital in these. Now let's look at column C, because when we're looking at distributions and income, we want to see how does the dividend hold up month over month? Has it fluctuated a lot? Has it gone down? Have we been losing value in our distributions? What is the case here? So it started out at just under 13 cents. As we just kind of look at this 2020, the second half of 2020, it pretty much stayed around 13 cents. And at the end, it snuck up here to 14.5 cents. And it started in 2021 around that same amount. It got up into the 15-cent range, dropped down a little bit again down to the upper 14 cents, and continued in that range again for a couple years here. You can see as we come down, it continued. And when it did draw down to that $34 in 2022, the dividend did come down a little bit, slightly to 13.5, but still basically where it started. So it wasn't like there was a big drop there. Now at the 32.80 price, the dividend did get down to just under 13 cents at 12.98. But again, it's recovered. And now look at it as we continue to come down, we see that now we're back up into the 15 cents here in 2024. 2025, we start getting into the 16 and 17 and ending into the 18. Look at that, 21 cents. And now starting out in 2026, it did have a 95-cent first of the year. And a lot of times that's catching up from different payouts that they have to do at the end of the year. So there was a little bit maybe left over that they paid out. So you had a really nice beginning of the year here, but then it's balanced back down here. It's 18 cents the last 2 months. So you can see that the dividend distribution has been growing at a nice steady pace. Now we're going to get into the full 100% drip. And this is the pure compounding test. No income taken, no lifestyle withdrawals, just math. If DIVO can't compete here, nothing else matters. Let's look at our full drip. Column D here, you'll see what the distribution is, starting here right here at $23.92, $2,392 the first month. And we're taking this amount and we're buying more shares. Whatever the share price is at the time, we buy more shares with that distribution. And you can see in column G, we're adding up our quantity of shares. Every month we're buying more shares. And we're just compounding. So we're adding more shares, the share price is going up, we're getting a higher distribution, so thus we get a higher dividend payment. As we come down column D, you can see how that began growing, got up to the $3,000 mark, did come down slightly. And let's look at that worst kind of scenario here where it got down to the $32.80 in October of 2022. Your distribution that month was still $2,700. Because you had a lower dividend per share, you've also gained almost 2,000 more shares during that time frame. So you're getting, even though it's a lower distribution, you're getting a higher amount paid out to you. But again, in this scenario, it doesn't matter because we're just reinvesting it and compounding with that distribution. We come down here to the end and we can see on column I the full value where we're ending up. And I want you to see, okay, this is stronger than most people expect from an options overlay. And I want you to see this as we look at this final number here. As we come down to the end, your portfolio has grown $650,000, 123% growth in this almost 6 years. It's been about 5.75 years going on here. It has grown from that 525 up to $1.17 million because you're compounding, you're taking these distributions, you're buying more shares. They've paid out, you can see here in this distribution, they've paid out $248,000 that you have reinvested into more shares. So you've added 6,534 shares and just added to that. You haven't taken any of the income. So now you're sitting at a portfolio balance, your unrealized gains are a almost $50,000 gain in that time frame. And that's just by reinvesting. That is the compounding effect. And so what a lot of people say, well, I'm in this for the income. But some people like preparing prior to needing it. They begin building up their share quantity by doing a full drip, excluding this January 1st payment, which was very nice, $23,000. Look at your payments right before that and right after that. $4,300, $5,200, $4,500, $4,600. That is your monthly payment that you've gone to from where the beginning was at $2,700. You've now increased the amount that you're getting paid. If you say, okay, now I'm going to turn the drip off, you've almost doubled what your monthly income will be because you compounded that. So that's a great thing to look at, and make sure you're taking that into consideration when you look at these types of funds. Now, this is where most investors actually live, and this is where income strategies usually start to separate. Looking at the balance line, it doesn't collapse when we're in the 50-50 mode. I want you to see that, because most people live here and they're taking some of the income but reinvesting some. Everyone I talk to on the channel is doing it a little bit differently, but the majority of people, most people, are in this doing about 50-50. And it depends on the actual fund. Some funds are doing more, some funds are doing less, but a lot of people, this is right where they're at. And you can see in column E, this is the 50-50 distribution. And this goes out to Scott Mobley. Thanks for all the fun humor with this, but we're going to explain this one more time. So bear with me, Scott. We have $1,196 as our distribution. And people will say, well, how's that less than the zero drip over here? Because 50% drip represents 50% of the distribution. So you see this amount, that is half of it. You're getting this twice. You get $1,196 that we'll use and we'll reinvest that. It's 50% dripping back in, so we're adding more shares, which we show right here in this column. We also get this $1,196 as income, because in this scenario, we're actually using some of the income. So we're combining income with compounding versus the full drip where we're just focused on compounding 100%. In this column, remember, each one of these cells, each one of these distributions, you're getting two of those. You're getting that two times. One time it comes and we're saying, okay, this amount is what we're investing back into it, and the same amount is what we're taking for income. So if you were doing the 50-50 in real life, what you would have is you'd have, we'll just say $1,200 here that you're buying more shares. And you'd also have $1,200 of income to supplement your income. If you're on Social Security, you have a pension, you have other funds that are driving income for you. This is just a way to get some income and not use all of it, but still compound your portfolio, your position with DIVO. As we come down here, let's look at the big reveal on this. You can see that we're still gaining. The amount is still going up, obviously not as fast. As you come down to the very end, you can see it's not exactly half of this, because you're only buying a portion of the number of shares each month. You're buying few less because you're not putting it all back in. You're only taking half of it and putting it back in. So there's an exponential growth in the full drip that you don't see in the 50-50. But it is still growing, just not as fast. In this scenario, you can see this is a really nice thing to look at. Your income over this 5.5-year time frame, you've received about $112,000 that you've reinvested, and you've gained 3,026 shares. But you've also received $112,000 as income over this time frame that you've been able to use to supplement your lifestyle. Taking out the amount that you've had as income, and look at this, your 50-50 balance, your portfolio is still over $1 million. You have a gain, or an unrealized gain, of $485,000 in your portfolio, plus you've taken out the $112,000 as income. And we'll look at that when we look at the total return, because you have to combine both. That's your 50-50 strategy. Now we turn compounding off completely. This is the stress test. For those that have watched the channel, you know this is where a lot of these funds can fail. You take the income and your portfolio is just crashing. If income was masking weakness, we'd see it here. And this is what we're looking at. And let's take a peek now at the zero drip. You can see right here, column F, this is the full amount that you're getting distributed. So matches the first month here, and it's double of this because, again, remember, this is half. So this, again, all three of these are equal the first month. But what happens after is really dependent on whether you're dripping 100%, 50%, or not at all. So here we're taking this as income. We're not buying any more shares. So your share total is 18,604. It's what you started with. It's what you'll end with unless you choose along the line to sell shares. These scenarios we're not selling shares. A lot of people in these types of covered calls and income-driven funds don't want to sell shares. That's the whole reason they're in them, is they want the income without having to sell down their shares. But they want the NAV to maintain because they don't want their portfolio being depleted, even though they're not taking and selling shares. As you can see coming down, it's been very consistent. We started at just under $2,400, and that's about as low as we head here until we come down. Again, we'll get down to that downturn in 2022. Let's come down here. October 2022, you can see it got down to $2,400, which is still nice. That's a very consistent monthly income for people who are retired and living off their portfolio. Consistency is often an element they're looking for, something they really want in their portfolio. They're willing to give up some upside for a little bit of stability. If you're 25, 35 years old and the market crashes, there's a lot of volatility, that's fine. You have years and years to ride that out. When you're 65, 75 years old, you don't feel like you have that time frame, and stability and minimizing volatility is often an important element. And so that's why these appeal to a lot of people who are looking to live on this portfolio now. As we come down again, you can see we never got over to $3,000. That 2022 was our lowest, but we didn't get above $3,000 here till the end of 2024. But that just shows that it is slowly going up. It's not huge pay raises by any means, but you're getting slight increases. As we come down here, now you can see you're up into the 3,000, obviously the low end of 3,000. But now as we get here to the last few months, again, minus the January big payout there, now look at that, you're getting $3,200, $3,300, almost $4,000 there, $3,400, $3,400. So you've increased your payment, the amount of money that you're getting, even by taking the full income and not reinvesting any. What happens here over the course of this time frame? You've received almost $208,000 in income. You have not bought any more shares, but while taking this $208,000 in income, look at this. This is really important. And I think this is really a great stress test and shows the value of this fund. $344,000 gain in your portfolio, the unrealized gain. Your balance is sitting at $869,000 that it's grown from that $525,000 while taking out this entire distribution. Again, that is great returns there. And this is more stable than I expected with this. And so I was a little bit surprised, but I think, what are your thoughts on this so far? Have you been surprised that DIVO has performed so well and seeing the numbers? We'll look at the total return here in a minute because that's really what matters in all three scenarios. But before we do that, now I want you to come in here because this gets interesting. Watch what happens if we only reinvest 35%. For those that have watched the channel before, you know we have these calculators over here where we can choose what amount that we're going to invest back in. So here we put 35% is what we're going to drip instead of 50% or 0. We want a little more income, but we still want to compound some. We don't want to go to the 0 drip completely. What we're doing here is you can see that we have the amount that is being reinvested, and this is the amount here in column O that you're getting as cash. So you are buying more shares with this amount in column N. And as we track this down, and again, we'll come down to the end, and are you surprised by how well this does even on a 35% drip? You've received $142,000 in income. You've reinvested $76,000, so you've gained 2,000 shares. Your portfolio grew almost $441,000. Very nice opportunity there to adjust what you're investing. And this is why we do this on these yellow cells. You can change and put in what you want to experiment. So if you got this sheet, you could say, well, I want to see what would happen if I did 10%. I just want to compound slightly, maybe increase the portfolio balance and grow the dividend to keep up with inflation, whatever your reasoning might be. Or maybe you want to do 90% and you just want to take a slight income. Maybe you're making a car payment off of it. I don't know. Everyone, again, there's hundreds of reasons why people do various things. And that's why we like putting these scenarios out and providing these sheets for you to customize them to what your plan is, what your goals are. Okay, now we're going to get into what I'd call this is retirement mode. Let's say you want $2,000 a month. We're going to go over here to this calculator and we're going to put in $2,000 a month. And that's what you're taking out. This is like truly retirement mode where you can say, okay, this is how much I need to supplement my income to help offset what I get from Social Security, a pension, rental incomes, whatever sources of income you have. I need my portfolio, this position to feed me, and we're going to say here, $2,000. And so it takes the distribution, pays you $2,000, and then reinvests the rest, whatever that amount is. And you can see the leftover here at $392 the first month. As we come down, again, one of the great things about a fund like this is you come down, you've received your $2,000 a month, every month, over and over, so $136,000. You were able to reinvest $107,000 and gain 2,733 shares. So your portfolio, your unrealized gain, as you've been taking $2,000 out to supplement your income, you have $459,000 unrealized gain. Your portfolio is sitting at $984,000. That is what DIVO can support without eroding your portfolio. In fact, not eroding it, but growing it while taking out a certain amount. And this is what matters. You don't want to miss this. This is the important part as we look at what most investors think income strategies automatically sacrifice growth. This one doesn't look as compromised as people assume. Let's look at the total return here. If we look at the full drip, our total return was 123%. That's an average of 21.5% annually because of that compounding machine of buying more shares, growing that dividend, buying more shares, building as your share price is going up as well. And that is your unrealized gain. You've grown at 123%. You can see over here in this column, the total value now is $1.1 million. And that's that gain of $649,000. Now on the 50% drip, you had $112,000 paid out and you had $485,000 in unrealized gains. You add those together, and that is 100 and almost 14% growth or 19.81% annually. Again, think about that. This is where most people live. You're in the middle, taking some income, reinvesting some, and you're still getting almost a 20% annual return, total return. Now, that's not your portfolio growth. Your portfolio growth, you can see here, is 92% overall. And if you divide that by 5.75, which is the number of years we've been tracking this, that would give you your annual return on your portfolio growth. But total return always has to add in how much income you've taken out because that's part of your return. And a lot of people forget to do that. And they'll look at it and think, the return on VOO or SPY is way better because they're just looking at the portfolio part and not the income they've taken out. Now, with this last one here, the no drip, we're taking a lot more income, but our portfolio still grew $344,000 or 65%. But add in the income you took out, that almost $208,000, that's $551, almost $552,000 of increase or 105% growth, averaging 18.25% annually. Again, are you surprised by DIVO, a fund that often gets overlooked? It's not a high-paying, high-yield. This isn't a Ulti. This isn't a Chippy. This isn't even a QQQI. This is a very modest yield. This is a very modest growth. But combining the two and getting that CAGR, that dividend growing month over month, and the growth of the share price, you see these scenarios, and it's pretty, to me, very impressive seeing that track record over this 5.5 years. What are your thoughts on DIVO? Do you like DIVO? Do you own DIVO? Are you thinking about buying DIVO? Leave me a comment down below. I appreciate all the suggestions, all the feedback you guys give. Don't forget, if there's a fund you want to see or even a comparison, like I'm going to be doing here, DIVO versus JEPI, let me know in the comments below. Most of the videos we do now are generated by your feedback and what you guys are requesting. I do appreciate that, and we'll see you next time on Simply Money.